China's economic growth momentum slowed in October. In October 2025, China's economic growth momentum showed signs of slowing. The International Monetary Fund, IMF, maintained its 2025 GDP growth forecast for China at 4.8%, citing a stronger-than-expected performance in recent quarters. However, the IMF also projected a modest slowdown in 2026, with growth expected to decline to 4.2%. This anticipated deceleration is attributed to factors such as reduced export demand, potential reductions in fiscal stimulus due to rising public debt, and ongoing structural economic deceleration. Trade data for October revealed a 1.1% year-on-year decline in China's exports, primarily due to a significant 25% drop in shipments to the United States. This marks the weakest export performance since February. Imports rose by just 1%, a substantial slowdown from the 7.4% growth in the previous month, reflecting ongoing concerns over China's property sector downturn and weak domestic consumption. Factory activity also contracted for the seventh consecutive month in October, with the Official Purchasing Managers' Index, PMI, falling to 49.0, its lowest in 6 months. This decline is attributed to a decrease in new export orders, following months of front-loading shipments to the U.S. to evade tariffs. Efforts to tap into markets in Europe, Latin America, the Middle East, and Africa have not fully compensated for the shortfall. In response to these challenges, the People's Bank of China maintained its key benchmark lending rates for the 5th consecutive month in October, reflecting policy caution amid a slowing economy. The one-year loan prime rate, LPR, remained at 3%, and the 5-year LPR stayed at 3.5%. Analysts suggest that the central bank may consider cutting interest rates or the reserve requirement ratio later this year to stimulate consumption and investment. These developments indicate that while China's economy continues to grow, the pace has moderated, influenced by external trade tensions and internal structural challenges.